After today's episode, the reign of the 4% rule as you know it is dead. And that's because there's a new distribution strategy on the block that you need to know about. This new strategy is called the Portfolio Waterfall, and as we're going to see, it's going to change the way that we think about risk in retirement. Good morning and welcome to the HopeFilled Financial Podcast. My name is Jay Disberger, your one and only HopeFilled Financial Coach, and I am sincerely happy that you're here with us today. The topic that I'm covering, the Portfolio Waterfall, may very well be the coolest and most important topic that I have covered to date on this podcast. And to get us started, I'm going to tell a quick story that's going to help us open our minds to the new system and strategy here. This story is one that I heard back in school. I was a member of Tau Beta Pi, and they had a leadership workshop on brainstorming in particular that students went through. This is a well-known real story that is shared not only through this program, but other leadership programs that focuses on making sure that ideas don't get shot down, and how in the brainstorming process, we are open to things that might even seem silly as we strive to improve existing solutions that have not changed forever or solve problems that no one has ever solved before. The story starts like this. Imagine you're in Alaska and there are towns that are remote. You have to go miles before you find another population center of any sort. And to get power out to these towns, you need to run power lines through just acres of wild, dense Alaskan forests. As you can imagine, it's extra important to keep the power on in the winter. And unfortunately, that's where this problem begins. You see, in the wintertime, ice forms on the power lines, weighs them down, and breaks them. And because these power lines are in the forest, they are difficult to get to. It is hard to not only restore power, but maintain these power lines. And nobody had a solution, so they brought in a brainstorming consultant. He said, as a part of this exercise, we need to think of anything that can help us keep the ice from breaking the power lines. Does anyone have any ideas for us to get started? And nobody would speak up. Everyone was afraid that their idea would get shot down. They didn't think that they had ideas that were actually going to work. They were kind of puzzling in their own minds, and they were not exercising brainstorming. They weren't taking advantage of the collaboration and understanding that could happen if they all got talking. This went on until the first recess, and the consultant, frustrated, goes to the restroom. Now, while he's in the restroom, he hears the janitor talking. The janitor had overheard what was going on, what little he did hear, because there wasn't a lot of conversation going on. And he jokingly told the consultant, how about we hire the bears in the woods to just knock the power lines free of ice for us? You know, they're already out there, then we don't have to take a truck out. It was a joke, but the consultant was excited. The consultant takes the janitor to the front of the room after the recess is over and with enthusiasm asks the janitor to share his idea with the rest of the group. The janitor is very taken back because it was just a joke, but he tells everyone, how about we get the bears to knock the power lines free? We hire them. And now, following the rules that they have, you're not supposed to shoot this idea down as silly. You're supposed to just continue with the idea and try to be creative around it. Someone else spoke up and says, well, how are we going to get our bears that we hire up to the power lines? This naturally begged the question, well, what do bears like? The next person to speak up must have been a Winnie the Pooh fan because he said, bears like honey, right? So what we need to do is put honey on the tops of all the power lines ahead of a storm so that as ice builds up, the bears are going to climb up the power lines one at a time to get the pots of honey. And while it might not seem obvious, they were getting somewhere. The question now is, how do we get the pots of honey onto the power lines when it's already difficult to get out there? Well, the next idea that came up was to get someone on a ladder hanging off a helicopter to place the honey pots on each of the power lines. Someone in the room who was familiar with flying helicopters said, you're going to have a hard time keeping the honey pot balanced because there's a significant downdraft from the helicopter, and after you place it, as you fly off to the next power pole, you might knock it off. I can't remember how conversation exactly carried on from here, but that was the pinnacle point that ended up solving their problem. They came back to it and said, wait, if there's a significant downdraft from the helicopter blades, and it would disrupt a honey pot if we put it on there, can't we just take the helicopter occasionally, fly low over the power lines, and the downdraft from the helicopter will shake the ice off of them as it builds up and keep them from getting broken. And this is still the same solution that they use today. Seriously, they solved the problem of frequent and difficult to remedy power outages in Alaska through a brainstorming session where someone suggested that they hire bears. Now, hiring bears is absurd, but the point of this story is some ideas that could be presented to us, we may dismiss right away. We might shoot them down. However, they could solve problems or improve the way that we utilize systems that we genuinely understand in our day to day. And this is going to be essentially what the Portfolio Waterfall does for your retirement. You see, Josh Curtis gave me a phone call after my infamous conversation with Dave Ramsey on the 2nd of November, 2023. And when I first heard about the strategy, I was a little skeptical, but I was open-minded to hearing about it and trying to understand how it worked. And to my joy, what I have to share with you in the main topic is very cool. For the main topic today, we're going to be discussing the Portfolio Waterfall. I'm going to start by describing how it works, understanding the system behind it so you get a grasp of the concept and how it's different. Then I'm going to pivot to the results from my proof of concept study where I compare it to my flat safe withdrawal rate study that was corrected for inflation back in January of this year. This is going to show a stark contrast on how, when it comes to the risk that you're exposing yourself to, the Portfolio Waterfall can be significantly safer than anything else that I've shared with you on this podcast before, and dare I say, anything else I've been exposed to since becoming a financial coach. And that takes us to how we're going to wrap up the main topic. I'm going to share with you some of the details and assumptions of my proof of concept model so that you can fully understand how I got to my results and you can trust them for what they are in the educational experience that I intend to share here with you. Which is a fair transition to the disclaimer that what I'm going to share with you today is not financial advice. It is strictly educational material for your benefit so that you can grow in your knowledge and understanding of personal finance. So, how does the Portfolio Waterfall work? I think the best way to describe the underlying mentality to the Portfolio Waterfall is with an analogy. Imagine that your retirement portfolio was 100% real estate, rental real estate, and you had a property manager, kind of like an investment advisor, but for your properties. And you own, say, 200 houses. All of these homes generate rent. Now, if the property manager is doing their job well, you'd imagine that they would maintain the properties, take the rent, and pay you what you needed to live on for your retirement out of the rent profits. And if there was anything left over after your needs and wants were met, use the excess to buy more properties. Now imagine a flip scenario where the property manager, instead of giving you just the rent to live off of, decides that, well, there are some seasons here where rent is light, so I'm just going to give you some rent, and I'm also going to be selling properties as I go along. We're going to be consuming the equity by selling off chunks of your portfolio. Well, that doesn't make near as much sense because your portfolio is going to be shrinking as the houses sell, and the propensity to generate rent for you is going to shrink over time until eventually you just run out. This is the same concept in the Portfolio Waterfall when it comes to shares of mutual funds. You see, we talked about it last week, how a mutual fund works, right? There are 4 main ways that a mutual fund makes you money as an investment. I highly recommend that you go back and listen to that episode if you need a primer on it. The real quick recap is they appreciate, they generate dividends, they generate interest, and they generate capital gains. And we typically think about capital gains as being a bad thing in our accumulation phase. We want something with a low turnover ratio if it's in a taxable brokerage account, because we don't want it to be generating taxes in general throughout the year when we're not selling shares and we're buying more and more of them. Well, capital gains are realized gains that can be distributed to you through mechanisms just like dividends through certain brokerages. I mean, think about it. The IRS is taxing you on your capital gain from the internal turnover ratio within your mutual fund shares. Should that gain not be something that is distributed to you? I think that makes a lot of sense. Otherwise, why would they be taxing you on it? Because it would be effectively an unrealized gain. But the gain is realized there. And truly, it can be distributed to you. And this is the thing that makes the portfolio waterfall unique. I've been getting comments because I've been covering different distribution strategies with mutual funds, but I haven't really leaned into ETFs. Part of the reason was gearing up for this episode. And when it comes to the ETF comment, there's a mentality that's like this, where you try not to sell shares of your investments and live off of dividends alone. The problem is with a well-diversified portfolio, one that an advisor might say is exposing you to an appropriate level of risk in retirement, you're probably going to be seeing dividends that range between 1 and 3%. And that dividend yield that you see year to year is going to fluctuate. But if we roll in the capital gains, in some cases, we're going to see that they're inversely correlated to the way that dividends get divvied up. Imagine this, the market's going down because the economy is getting squeezed. And as the economy is getting squeezed, company profits are as well. So your dividend is going to suffer. But fear is going to be driving sales of these falling markets. And those sales are going to, through mutual funds, generate capital gains. And utilizing a strategy like this, fund selection is going to be very important because you want to have something that's going to be not only producing dividends for you, but also elements of your portfolio that are going to produce capital gains. And both dividends and capital gains, depending on the mechanisms that are producing them, are not always available month over month for you to take as a distribution. They vary. Sometimes you can get them monthly. Sometimes you're going to have these paid out to you quarterly. Sometimes it might be annually. Depends on the fund. This means that we're effectively going to be taking a trickling of cash with a dump of cash every once in a while. It might make it a little difficult to maintain a consistent distribution month over month. And this is where the concepts behind the bucket strategy can actually come into play with a benefit. We've covered the bucket strategy before, and one of its major downfalls is that after you consume the cash within the bucket, you have to find a way to refill it. Well, the portfolio waterfall works around this by simply always filling the cash bucket, or the stable fund within it, as Josh would call it. If we are constantly filling it with the dividends, interest, and capital gains that are being generated by our mutual fund shares, and we're not selling the shares of the mutual funds, well, it can dump the water in, and we can let a little bit out of that stable fund every month so that we can live off of it as our stable, consistent distribution. Meanwhile, as it gets lower and lower and a major quarterly or annual distribution comes through from our shares, we dump it in, fill the bucket back up, and if we manage it correctly, we should be able to maintain that consistent distribution over time, seeing minimal interruption, and hopefully achieve the goal of not selling any of our underlying mutual fund shares in our portfolio. And if these shares are able to keep up with inflation through appreciation on their own, well, what we have is no longer a consumption model where we're eating our rental properties and driving it all down to zero. We have something that can generate income perpetually. And by integrating capital gains, we're no longer limited to the low 1 to 3% that dividend-only portfolios can have. The capital gains element here is going to give you a diversified flow of cash into your stable fund, which is going to be able to significantly raise your safe withdrawal rate. And that ties nicely into the next part of the main topic, the results. And it's for this part of the podcast that if you're an audio-only listener, I'm going to encourage you to go find the video on YouTube or Rumble later because you're going to want to see these results for yourself. To get started, these are my 20-year time horizon results from the study back in January. We'll link that in the description below. What I did in that study is I took these safe withdrawal rates over here on the left and I ran them through a retirement simulation with no deviation or correction throughout the 20 years. And I did that for each of these portfolio mixes, ranging from 100% bonds all the way up to 100% stocks, or even my 401k, which is very aggressive. And within the table, you can find the percentage of cases where the portfolio did not run out of money. That's what this represents, your success rate in hundreds of thousands of simulations. In January, we talked about how anything that was 95% or better for a Monte Carlo simulation, which is the type of simulation that I ran, anything 95% or better is considered relatively safe by most experts. And also in my table, I drew this double bordered line to encompass anything that had a 90% or better success rate. Now, it doesn't take an expert to see that the portfolio waterfall here has the highest rates of success down the whole board. For example, where a 50/50 stock bond portfolio mix with regular rebalancing results in a 90.1% success rate in my study, the Portfolio Waterfall achieves a 98.8% success rate. And for the 7% safe withdrawal rate, none of the traditionally rebalanced portfolios were able to break an 80% success rate, as opposed to the Portfolio Waterfall here that hit 87% success at a 7% safe withdrawal rate over 20 years. Okay, Jay, you might say, the survival rate for the Portfolio Waterfall method is impressive, and the safe withdrawal rate for 20 years being relatively safe up to 7% in your simulation looks awesome. But what's the trade-off? What's the catch? What am I giving up in order to make this a reality? Well, remember when we covered the two-bucket strategy, part of the trade-off was by sidelining cash for good chunks of time, we're going to be missing out on some of the appreciation that it can gain. Well, that's going to be somewhat the case here with the Portfolio Waterfall. I don't have in my proof of concept study a buy more shares mechanism because too much cash is sidelined until it hits 25% of the portfolio being in the stable fund or cash equivalent. So with that being the case, you are sidelining a good chunk of the portfolio, and the overall growth is going to track behind something that's going to be more aggressively invested with a higher risk to you for running out of money due to volatility and sequence of returns risk. How much of a trade-off there is according to the proof of concept that I had in the particular portfolio that I tested with this strategy can be seen here. Effectively, what I see is the accumulation is roughly similar to that of a 50/50 stock bond portfolio mix, and it's going to underperform anything that has a higher concentration in equities. Given the particular funds that I tested and the simulation model that I built for the Portfolio Waterfall, the average ending nest egg value that is received for the various distribution rates, the various safe withdrawal rates, is very similar in the Portfolio Waterfall column as the 50/50 stock bond mix column. But ultimately, the trade-off here is you need to have a stable fund where everything pools, all the cash that's generated through interest, dividends, and capital gains. And when that pool is full for an extended period of time, you're going to be underperforming these consumption-related models with rebalancing that are heavier in equities. Again, purely under the assumptions that I had within my study that we'll cover later. All right, but that was just the 20-year results. What about 30 years and up? If we look at the 30-year results from my study back in January, we see that the only two portfolios that are able to maintain 4% is a safe withdrawal rate are the 80% bond, 20% stock portfolio and the 50/50 portfolio. In contrast, though, the Portfolio Waterfall maintained a 5% safe withdrawal rate with a 99.1% success rate. Remember, the threshold here for success is around 95%, but 99.1. That's impressive. And the 6% safe withdrawal rate under the Portfolio Waterfall was still able to maintain an 84% success rate. The next best performer at a 6% safe withdrawal rate is going to be the 10% bond, 90% stock portfolio with traditional rebalancing, and it only had a 69% chance of success. Now let's take a look at the 40-year results. In these results from January, the safe withdrawal rate all shrank a little bit for everything. In fact, at a 4% safe withdrawal rate, the best you can do in the study I had was a 92% success rate under a 50/50 portfolio. And the highest safe withdrawal rate that was able to maintain 95% or better was with the 80% bond, 20% stock portfolio with a 95% success rate and a 3.75% safe withdrawal rate. Contrast this with the Portfolio Waterfall that after 40 years is still 96.6% successful at a 5% safe withdrawal rate and 64% successful at a 6% safe withdrawal rate. Now let's really get into the results for the FIRE crowd. These are the 50-year safe withdrawal rate results, and we can see that the best we can do with a more traditional approach is a 3.33% safe withdrawal rate with either the 80% bond, 20% stock portfolio, or the 50/50 mix. And again, by contrast, the Portfolio Waterfall is able to still maintain a 5% safe withdrawal rate with a 93.9% success rate. And the 4.5% safe withdrawal rate still gets 98.7% success in the Portfolio Waterfall. If I had to find a way to characterize it, the Portfolio Waterfall seems significantly more stable in the long run. And while everything else seems to trend to lower and lower safe withdrawal rates, the portfolio waterfall is not nearly as impacted. This effectively means that the portfolio waterfall, through its understanding of the processes of mutual funds and the excellent application of the principles behind the dividend only mentality and the two bucket strategy, is able to almost entirely solve the problem of time and sequence of returns risk. Not entirely, but almost. It certainly solves it better than anything that I've ever seen before, and it's not even close. And that might be best characterized by the longest time horizon I studied, which was 60 years. The best safe withdrawal rate now for the traditional portfolios with the traditional flat safe withdrawal rates is 3%, and you got three portfolios that can manage at 3%. It's going to be the 80-20, the 50-50, and the 30% bonds, 70% stock. Those are the ones that can get up to 3% for your safe withdrawal rate. The portfolio waterfall, on the other hand, is still 91.3% successful at a 5% safe withdrawal rate. And at a 4% safe withdrawal rate, 99.4%. That's taking out a flat 4% over 60 years with no correction, no deviation to pivot when markets are sad. Now, if you think that's cool, check this out. This is the anticipated ending nest egg value over the 60 years for the varying portfolios. If we take a close look at these numbers, you'll see that the portfolio waterfall now looks significantly more attractive in the real long run. Its ending nest egg values are most comparable to a 100% stock portfolio over the 60 years for nearly all safe withdrawal rates. Okay, in some cases, it might be the 10% bond, 90% stock, but the case still stands. These results are nothing short of astounding to me. The portfolio waterfall in the 20-year time horizon seemed to lag the stronger equity positions, but over a 60-year time horizon is able to get very close to an all-equity portfolio for the expected ending nest egg value, only paling in comparison to going with my 401k over the 60 years, which again is so aggressive that the best survival statistics that you get for it are at a 2.8% safe withdrawal rate of 89.3% success. Now, if you've made it this far in the podcast, first and foremost, I thank you for listening. And I thank you for keeping an open mind to what this strategy can do. It's important now that if you're serious about learning more about this, that we talk about my proof of concept model and the assumptions that I put into it. I didn't want to bog down the beginning of this episode with all the technical assumptions like I did the last time that I covered one of my studies, because in this case, it's not a Monte Carlo simulation. It's a little bit more involved. And there are Monte Carlo-esque randomizations in the simulation, but there's a lot of custom modeling that goes into this that makes it very unique to what I have done and shared with you so far. Let's jump right into it. When I first talked with Josh Curtis about the portfolio waterfall and sharing it with you on the podcast, if it panned out to be something that I thought was really valuable, well, I needed to do a proof of concept. And to do that, I needed an illustration from a portfolio that would function adequately under the portfolio waterfall system. What I got, in his words, was not the optimal mix of funds. What I got was a mediocre beginner. It works, but it's not the best. And the results we saw come from these four funds, which are generic here because I'm not endorsing any particular funds. Just imagine what a more optimized portfolio could do. Anyway, for the model that I had, my proof of concept, I had four investment funds. We'll call them Fund 1, 2, 3, and 4. And I also had a different fund down here for the stable fund or the cash pool. So funds 1, 2, 3, and 4, they're not rebalanced over time as their appreciation changes, but they all produce varying levels of interest, dividends, and capital gains that flow here into the cash pool fund. But it itself does earn dividends that adds to the cash pool. And naturally, because it's my work here, I have an entire row dedicated to correcting for inflation month over month. That way, the results from this simulation are comparable to the work I did in January. Jumping down a little bit, I assumed that the cash pool or the stable fund was going to start at 1 year's worth of distributions in it. So if we have a 4% safe withdrawal rate, as is illustrated here in the sample inputs, that means 4% of the portfolio starts in the stable fund, and the rest get divvied up across funds 1, 2, 3, and 4. Next, if the stable fund ever hits a balance that is equal to or greater than 25% of the total portfolio value, well, we're going to take the excess in the stable fund and purchase shares of equal amounts of value for each of funds 1, 2, 3, and 4. And if the stable fund ever drops below a half year's worth of distributions, we are going to default into a consumption emergency mode in order to maintain this stable fund, i.e., we're going to start selling shares of funds 1, 2, 3, and 4 in equal value in order to fill the stable fund. This is again a violation of the principle behind what makes the portfolio waterfall valuable, but we cannot ignore that when you get to a high enough distribution rate, it's very possible that you start to consume the stable fund faster than it's being filled up. And that's naturally going to depend not only on your fund mix, but the dividends, capital gains, and interest that are flowing out from all of them on an average annual basis. If your consumption rate, your distribution rate, exceeds the average that's coming out of these over a period of time, you're going to eventually start to eat into the shares. Now, before going into the simulation and the way that I built it, I took the historical data and made a portfolio calculator. The historical data that I had for all 4 funds plus the stable fund go back to 1993. And what I wanted to do was get a proof of concept to see what safe withdrawal rate was historically actually achievable at its maximum. That way I could look at it and say, well, if I have significantly higher survival statistics than this percentage, my simulation's probably off. And if I have good results that fall short of this maximum, I'm probably on the conservative side. Over here, I have an input for the safe withdrawal rate, and this not only ties to the simulation, but the historical calculator. If I come in here and I type in 7.4%, the total ending nest egg value from the calculator portion is not 0, which means 7.4% survived for a period exceeding 30 years, from 1993 to present. That's almost Dave Ramsey 8%.
If you want to pull out 10%, you're not going to destroy the portfolio.
Those results are nothing short of astounding. 7.4% being safe over a historical backcheck from 1993 to present, exceeding 30 years. That's wild. Now let's talk about this graph here. This is a graph from the simulation, not the historical data. You see that there are these spikes. That's when capital gains pays out in the simulation. But the value of the cash pool doesn't drop below a particular floor. Up until about right here, 19 years in or so, the portfolio crashes and runs out of money. Now this is with the 7.4% safe withdrawal rate that's typed in above, right? If we were to type in something that was a little bit more conservative, like 4%, what we get isn't a graph that seems to bottom out all the time, but we see something that is largely growing, has these spikes as capital gains, quarterly or annual cash distributions get poured into the portfolio. It drops a little bit and then gets refilled before plumbing out to the floor. And if it hits the floor, it doesn't hit that floor very often. This is something that illustrates the stability within the portfolio waterfall. With that, let's talk about the assumptions that were made in my proof of concept model. I took the historical data for funds 1, 2, 3, and 4 and created a moving standard deviation in average growth for the NAV, net asset value, of all 4 funds. And I made it so that they were combined in share quantity, that they were not rebalanced, and replaced them with an equivalent simulated fund. That way I wouldn't lose the correlation across them. That gets simulated using something that's very similar to a Monte Carlo simulation. I did the exact same thing here for the stable fund, which has a negative average growth, barely, after correcting for inflation, and I blame some of the higher seasons of inflation for that, but it's still valuable to simulate here. I didn't do anything in relation to correlation correction with this fund because it is so wildly stable and the variation within it where it wasn't going to really radically impact the results. Now we get into the fun part when it comes to the monthly, quarterly, and annual distributions. I had to model each of them independently and show standard deviation variation for all of them based off of the historical results that randomized a yes or no function basically, then randomized variation in them as the capital gains and the dividends are nothing if not inconsistent year over year, month over month, quarter after quarter. This was the most challenging part of the model. And I made it so that there was a baseline monthly cash flow that comes out, just like in the historical data, that varies year over year. And then the quarterly spikes vary based off of a respective standard deviation, and the annual ones are based off of the larger chunks that are only seen in the historical data annually. I compared visually and analytically the outputs from all three of these and then superimposed them on top of each other with their respective randomizations. I also assumed here for the average change in growth for the dividends, interest, and capital gains, 0. Reason being is if I were to take a short trend and show a slightly negative or slightly positive change here, it's going to result in either, for positive average growth here, explosions on a 60-year simulation that aren't realistic, or crashes that aren't realistic, because you're not going to see perpetual decline at an average linear rate with dividends and capital gains. It's going to vary and fluctuate. So what I did is I built in corrections to the standard deviation and made sure that the average change was flat relative to inflation. And I did the same song and dance for the monthly dividends that were paid out of the stable fund. And that gets us down to what I consider to be the coolest part of the simulation, and that's going to be these correlation factors. I took a correlation between the net asset value on the historical data and the cash that was produced through all different means, the superimposed monthly, quarterly, and annual cash input into the stable fund. And I ran a correlation to those two. Then I ran a correlation for that in the simulated data, again, between the net asset value of the equivalent to funds 1, 2, 3, and 4, and the cash that they generate. This correlation factor is important because if the market is good and it's going up, I want the cash generated to reflect that same sort of correlation. And if it's bad, I want it to correlate. If I simulate these independently with independent random numbers, I run the risk of having completely uncorrelated data that's unrealistic. And I couldn't have that. And I can't come up with a way in Excel to simulate correlations in such a way without combining them the way that I did in the studies in January. But for the studies where we're testing the 4% rule, as it was with different safe withdrawal rates, just a flat distribution, we're treating mutual funds, our portfolios, as black boxes that are growing and shrinking without having any understanding of the systems behind them. Here, we need to be more complicated with our modeling in order to do the portfolio waterfall justice, in order to truly get something that is realistic. Now, this is one of the biggest assumptions that I made in my model here for the proof of concept. I took 5-year correlation factors that were rolling between the historical data and the simulated data. And what I've done with these is I ran them along these rows on a monthly iteration, all the way down to the end. I take the historical data correlation factors and create ranges out of them, basically plus or minus 25% of what was given for the maximum and minimum. And then there's a plus or minus 50% for the actual average. If the correlation factor maximum, minimum, or average deviates outside of the acceptable range, I consider that particular data set in the simulation untenable. And I throw that simulation out. What I have here is a data table. It's not active right now. But if it sees that the simulation correlation factors are out of tolerance, it throws a bad up here in the cell that you see bad. If I type in random numbers in the spreadsheet, it will continue to generate new random simulations each time I make a change. And eventually, we get a simulation that says good. That means the correlation factors up above all fell within their tolerances, and we can get ending nest egg values and survival statistics that are quote unquote reflective of a realistic simulation. A realistic simulation where the cash generated from dividends, interest, and capital gains is reasonably correlated to the appreciation in the underlying investments, the net asset value of the invested portfolio. A problem with this is that only 10%, 11% of the data that is simulated is usable. The rest of it gets thrown out. But that which stayed, which was good and correlated within reason under my assumptions, is what produced the results that I shared with you earlier. Results that I think are conservatively reflective of what the portfolio waterfall can actually do. I didn't want to do something that was overly optimistic. It is impressive what I was able to share with you. And here's what I mean by that. This is the Portfolio Waterfall website. I'll link it in the description below. But if we scroll down here, it explains a little bit of how the system works. They say right here in their advertising on the website that the Portfolio Waterfall income is between 6 and 8%, which does match what I saw in my proof of concept. Again, the historical back check for 30 years was safe over 7%. It ate up the portfolio down to failure, but it did survive. And they show that a traditional income strategy is 3 to 4, which correlates with the 30, 40-year time horizon data that I have in my historical studies. In closing, I need to recognize a unique irony here that is not lost on me. I caused Dave Ramsey a lot of grief for his 8 to 10% safe withdrawal rate claim. And I came in fully and wholly wanting to save his listeners from heartache and pain by showing them what came out of the Trinity study in 1993 and 1994. I wanted to change Dave Ramsey's mind because sequence of returns risk was something that I didn't think could be beat without simply reducing your safe withdrawal rate to conservatively account for the increased risk. What I'm going to do personally with this information is I'm going to still plan around a more conservative safe withdrawal rate, and I fully plan to implement a strategy like this. Find someone who's able to engage with the mechanism that allows me to harvest capital gains in retirement. I want to engage with this because of the increased efficiency and security that I have buffering between me and sequence of returns risk. I think it's beautiful. I think it's cool. And I think it's going to rock the investment industry. I think retirement as we know it is going to change as a result of this. But I don't think that we need to plan around what we've seen historically using this system. I think we should still be conservative in the way we plan for retirement. Let's say we planned around a 4% safe withdrawal rate. If the markets do what they've done historically, we could probably sustain with the portfolio waterfall higher than 4% safe withdrawal rates quite handedly if what we saw today is truly reflective of what is possible in the future. However, let's say markets don't do what they did in the past. And what's safe at 4% today might be safe 3% under traditional rebalanced portfolio methods, where we're taking flat safe withdrawal rates and treating our portfolios like black boxes. Well, then, if we're able to engage with the portfolio waterfall, we might be able to get back to what we originally planned around, even if we go through a really difficult spell in the markets in the future. And again, that's not financial, investment, or retirement advice. It's what I'm doing with the information that I've shared with you here for educational purposes. And it's something that I sincerely hope that you share with those you know and love so that they can grow in knowledge and financial literacy in a way that is revolutionary, in my opinion. And with that, until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.